Happy Wednesday. Welcome to another week of the Educated Homebuyer Live with Mr. Lewis, Mr. Josh, and myself here to answer your mortgage and real estate questions, update you on the economy, have some fun while we're doing it. Josh, wearing new Meta glasses tonight. Do I look
I
smarter?
didn't notice. I hadn't noticed, Jeb, that you had the glasses on that you've
Do I
never
look
worn
smarter?
before. You look way smarter.
The reason
The
I have
question
these
you should
on,
ask the audience, Jeb got this size. Does he is this the right size or does he need the bigger size?
do I need the bigger? I ordered the bigger once I got these because I feel like my head's too big for these, but you guys let me know. The reason I bought these, Josh, is in case somebody ask a question that I don't know the answer to. I'm just going to ask Meta to tell me the answer so that I can just relay it.
Meta is no Josh GPT. Let's just say that.
All right, guys. Yeah, I don't know that I could do this the whole episode. So anyway, we're going to take those off for now. Welcome. So biggest news this week, Josh, is probably just volatility in the market, right? We talk about it every single week. Last week, we had interest rates sitting 4-week lows or 4-month lows rather. And now we've seen interest rates climb to back in the 6.7 range or so.
Mortgage News Daily, you guys will see, has it at 6.8, up 0.1 over the last week. Last night, I locked someone at 6.499. Now, granted, 800 credit score borrower. So most 700 plus credit score borrowers are still under 7% safely, and the FHA and VA stuff is in the low sixes. So definitely much better. It's not like we've given back a lot. The headlines like to make little tiny changes and moves in the market sound like a big deal. Not much difference there.
And the biggest news, which I did not mention, daylight savings, Josh. It is now going to be light when we leave here, which is just fantastic. But also with that, a brighter background for you guys. So anyhow, we're going to start as we always do, and we're going to look at some charts. While we're doing that, do us a favor, put your questions in the chat so that when we come out of the update, we can start answering your questions. Let us know where you're watching from. Success stories. If we've helped you in any way, let us know. We've got a bunch to talk about tonight of people that we've recently helped. Yeah, that's what we're going to do. So Josh, let's take a look at inventory as we always do. Continuing, actually, we're trickling up at the moment. Currently sitting at 642,000 active single family homes on the market, up 28.3%. So that's good news. Last week we were sitting at 639,483. So up about 3,000 homes nationwide. So nothing really to jump up and down about, but you'll see here in Orange County, Huntington Beach, we're starting to see some increases. So that's going to help all the locals here. We're sitting Orange County, 3,349 homes. So the last time we saw this, Josh, was back in October of, late September, early October of last year. I think the peak last year was somewhere around 3,650 or so homes. So about 300 short. My guess is we're probably going to hit it before we end March. And Huntington Beach sitting at 240. Last year, the peak in Huntington Beach was in October, around October 16th, just over 250 homes. So Josh, we're going to be there probably by the end of the week, early next week, with regard to inventory. So it's a positive sign if you're a home buyer out there looking in either of those markets. But my guess is if we're seeing it here, we're probably going to see it nationwide too.
Well, before we move on, let me ask you on that. So are you seeing locally any difference, Huntington or Orange County wide? Easier getting offers accepted, less competition when writing offers?
We talked this morning on the podcast about a property we're putting an offer in on, not here in Orange County, LA County, but there's, as of yesterday, there were 17 offers on it. It's at a sweet price point though. It's under 700,000. My clients are doing things that we did a couple of years ago in order to help get our offer accepted. We're shortening contingencies, shortening time frame, escrow time frame, going above the asking price, doing all of that stuff. That's a tough price point. So the lower price points, I know people across the nation are going, what, 700,000 is a lower price point? It is for us here in Orange County. Really under 1.5 still seems to be moving quite a bit. I've got a handful of buyers in that price point. We're talking about listings every day. There's a lot more out there, but the good stuff is still moving pretty quickly. Yeah.
I would say similarly. Deal got a contract in Ontario last night. Same price point, 680 was the list price of that one in La Puente. But anywhere in Southern California, that is about $100,000 below where it kind of opens up. At 850, there's a decent amount of entry level stuff for us in Southern California. If you get to the low end of that entry level SFR, there's a lot of people that really don't want a condo, don't want to go further out, and they all will fight over these properties.
It's weird because here where we are in Orange County, you know, it's really hard to get a single family under at least $1 million, right? Huntington Beach under 1.2. So, you know, people feel really weird about paying, you know, 8, 9, $1 million for a townhome condo. It's that weird price point. Like anything under 800,000, people are like, oh, that's a townhome or condo, and that's where I am. And then the people above that really want a single family. They don't want the townhome condo, but that's their price point. But yet they struggle with paying that much for it because they're like, it doesn't check all the boxes. I'm not where I want to be. Should I do this? And then those above 1.2 are still getting the single family. So it's a weird dynamic out there. Don't feel alone if you're in that world, because a lot of people are going through it.
And don't get hung up on those numbers, because I feel like,
Sure,
yeah, that's a psychological number for Orange County, that $1 million thing, but there's a number in every market. Your market might be 400 is the sweet spot for an entry level home, and at 325 is where everyone is competing and fighting. So it might be 600, it could be 400, could be 500. Every market has that number. And for the most part, what I'm seeing around the country is if you're on the low end of that entry level single family residence, it's still, there's going to be some level of competition.
Yeah, good stuff. So new listings saw a decent jump this past week. 76,000 total homes hit the market, or new sellers, with 64,000 new listings with 12,000 immediate sales. So, you know, part of them go under contract as soon as they come on the market. Home prices, median home price pending home sales was at 389, which is essentially unchanged from last week, but 2.6% above last year. And then active market median price is sitting at 435, and that's just fractionally above 2024. Home sales on, well, this is pending. So 63,000 single family home sales. That's up 5% for the week, and but still 2.6% fewer than last week. So why the jump in home sales? It's in pendings rather. It's because interest rates, right? I think we saw interest rates decline for 5-6 weeks in a row. You know, not huge decline, but over that period of time, it's been a sizable decline. You know, we talked about it last week, you know, almost 3/4 of a point, Josh. So that makes a big difference in a lot of people's budgets. And then actually following up to that, after 7 weeks of declining mortgage rates, price reductions actually took a little bit of a breather, but just by 10 basis points. And we're sitting at 33.6% on price cut. So more homes on the market right now getting price cuts, and that's because we have more homes on the market for one, but it's also because of rates. So tonight, you know, the title of tonight's episode has to do with the idea that, you know, housing costs are up 79% over the last 5 years, Josh. So 5 years ago, 2020, the household income needed to afford the financed purchase of a typical valued home, it's nationwide, was $51,000. Now it sits over $90,000. And I know you guys are watching this going, who can even buy a house with that salary? And that's the reason that I show you a chart like this. And that shows you what it looks like in 2025, depending on where you're located. You know, those $50,000-ish salaries are middle America for the most part. Whereas you see the coast, the areas that have appreciated essentially the most in you know, outside of some pockets of Texas and Idaho and, you know, Nevada and Arizona, it's really the coastal areas that need the majority of income, and that's where house prices are the most.
And
So,
Jeb, I don't want to sound like I'm on a soapbox, but if you look at this, it's really pockets of the country that are densely populated. So many of you watching live there. Many people want to live there. But you're going to see the few of these transactions we've closed, and a few of the people whose refinances we're working on right now. I look at these properties, I go, it's a really nice property. Why would you sit here and say I am getting beat out on $800,000 homes that are not nice in Southern California versus a $350,000 house in Florida or Texas. Again, there's reasons why people have migrated, and what is the obvious response that everyone says? Well, my income is located in Southern California. When the home is a third of the cost and housing costs are 40 to 50% of your household expenses, you don't need to make as much money. So again, easy for me to say, old man who owns a home, bought it at a much lower price. But I think home ownership is important. And you look at that map, most of the country is fairly affordable. The areas where everyone wants to live are not.
Taking a look at delisting. So Josh, there's this idea at the moment that people are delisting their property. That's a problem for house prices. It's a problem for the housing market. It's going to crash. Let's talk about delistings. What does that actually
It's a
mean?
problem for supply. What have you and I always said? Absent distress, meaning I have to sell. It's not optional. I've lost my job. I've lost my wife. I'm living a country song. Other than that, what happens when a seller can't get their price is they take their home off the market. So when we look at this, we're still way below the levels, even from 2010. So they spiked from 2006 through about 2010 or so, 2011. We're still below that level. It's definitely increasing, but this is, to me, when I see this, I go, this is anyone commenting on this as this is a sign of weakness to come doesn't understand what this is saying. It's saying that there are people out there who are willing sellers, but are unable to sell because it doesn't mentally sit right with them, or it doesn't allow them to accomplish what they want to do. And as a result, they will post up and wait 3, 5, 7 years until they get that magical number. It's not necessarily rational when you look at the long term of what those numbers do. But we've seen it over and over again over 50, 60 years. People don't sell if they don't get the number they want or need, and they don't have to.
Always, always, always. So what are we looking at?
Average property insurance premium increase. So we look at this 2015, it was $1,300, and now we're up to $2,290. So that's a lot, right? I mean, there's no two ways about it, but in context, it's $1,000 in 10 years. So it's $100 a year. Over the last couple of years, it's been a couple $100 a year. People are throwing out this idea that this is going to lead to additional supply. People are going to get priced out of their home because of homeowners insurance. And for 98% of people, that is not the case. Are there people who live in risky areas where that number is going to be absurd? And, grandma and grandpa own their home free and clear, and they're in a hurricane prone area, and it goes from $4,000 a year to $12,000 a year. That could be a problem. But for the most part, on the aggregate, it's not a big deal that is going to massively impact things. Well, it's going to be unhappy for people. I mean, mine, I think I've told you guys, has gone up $700 in the last 2 years. I don't like it, but is it making a problem in my life? It's not.
But also understand it impacts. I mean, this is not just a homeowner issue. This is a renter issue as well. I mean, what do you think when a landlord owns a property and insurance goes up? They're not just going to eat that cost of insurance. They're going to pass that along, as much of it as they can. In most cases, not everybody's going to do it, but it's going to get passed along to tenants. And, instead of, a 3% hike a year, maybe now it's a 4 or 5% hike, because people have some sort of, baseline as to what they're willing to accept on a monthly basis. And, and if that means me having to pass it along to you so that you eat some of it, chances are that's what's going to happen. So, everybody's like, home ownership is you're not fixing the payment because all of these things go up. Well, guess what? Rent is very similar in that regard. So this is not just a me problem or a you problem. This affects everyone.
It's that pithy little saying that a lot of realtors will like to use to say, well, you can either pay for your own house payment or you're paying someone else. You pay your own mortgage or you're paying someone else's. There is truth to that unless you live rent free with someone who is paying their own mortgage, and out of the kindness of their heart, or they think you're cute, or they're related to you, or you're their child.
Cute, huh?
It's well, lots of handsome young men find free housing, Jeb. Maybe if you keep the glasses off, you'll be able to find that. So this one here, I thought this was interesting. Millennials now own more than 20% of the U.S. home market. You see boomers still have the biggest share. Next is Gen X. And that's really just, it's that age cohort. Those are the prime buying ages, and they haven't aged out of the market. Silent generation, unfortunately, that is the silver tsunami. They are dwindling, and they will dwindle down to zero. And millennials will keep growing, and they'll overtake Gen X here in the next 5 to 10 years, regardless of what happens with the market, just because it's a bigger generation, and they will buy at similar rates as generations prior to them. This one I thought was interesting, Jeb. We saw this in the newsletter from someone that you get every week, an MLO count. And this is from Redder. Redder is a tool that we can use in the industry to look at other people's production, both on the real estate and the mortgage side. So these are counts of loan officers who have actually closed one or more loan in that calendar year. So from 2019, 240, 2020 rates drop, it goes up to 260, 2021 up to 287. 2022, most of them hung around and still closed another loan. And in 2023, we saw the big drop of 50,000, then another 15, and now another 20. I don't think this is any cause for alarm. 200,000 loan officers that closed at least one loan last year. There's plenty of them. You'll be able to find one if you need a loan. We have one, and we have a link we'll share with you that will get you connected to someone. This, Jeb, we hear this a lot. Oh God, everyone's they're over indebted. I don't know how people are getting by. We are now just back up to the pre-pandemic average in terms of credit card utilization of 24%. It's been higher in periods of distress before. 2009, 2010, it was up 28, 29%. Most people are not in trouble with credit cards. The big difference, that top line, the gold one there, Jeb, that is home equity utilization. People are not tapping home equity. The last time around, there was a lot of home equity, mortgage equity withdrawals, and it led to problems. So lenders learned their lesson, and borrowers.
It was a lot easier to get it out.
Easier to get it out, cheaper to get it out, and just the sting of that. Lenders have made it harder and more expensive, and borrowers just like, I don't. And it's probably good. It is very.
No, it is good. It is good.
We don't need to use houses as ATMs. This one we had kind of talked about last week, Jeb, what people were doing of having more and more of their household net worth in equities versus Buffett having more and more of his Berkshire Hathaway wealth in cash. This shows average 15-year returns of every 15-year period since 1970. We are in the best 15-year return since 1970. So if you look at that, not everything mean reverts. Is it possible that we come back in a year, that 15-year period is the best? Yeah, it's absolutely possible. But at some point, you do need to expect some level of correction. So if you are believing, hoping, expecting that we're going to continue to see the next 15 years like the last 15 years, probably not going to be. And we won't have as much of a wealth effect, and it won't stretch over into real estate, housing, any number of other things, though, the way that it has. So Jeb, this is my favorite slide of the week. This is one of our OGs here. I believe Barb was with us from almost the very beginning.
Wow, the beginning
of the live show. She was here in Southern California and relocated to the Villages in Florida. She's rented there for the last couple of years. She wanted to get the feel for it, make sure she liked it. And that beautiful little house right there, she just closed on Monday.
And Josh photoshopped that, by the way, guys.
She wasn't taking her own picture in the driveway. That'd be pretty cool if it was.
But Josh, you have that one, Xavier in Houston, Hannah and Luis in Houston, Ben and Sam in Mesa, Caesar was a refi here in SoCal, 6 more purchases in escrow at the moment, 2 refis in process, and 2 to 4 more ready to save. And I think there's 100 and I don't know how many people on the rate watch list.
We cleaned it up yesterday. There were some duplicates, and we wanted to make sure we had accurate information. For those of you on the rate watch list, we're going to be reaching out with an email and probably with a phone call just to clarify what we have and set a strike rate. So we can go through with your loan amount, your current interest rate. So we know as soon as we hit this point, boom, it's go time. We're ready to go. But Jeb, 122 as of yesterday on that cleaned list, and a couple more joined it today. So if you have a rate that you're not happy with, and anyone after 2021 has a rate they're not happy with, let us know. I mean, there's people, I think the lowest I saw on that list was someone at 5.625, which again, for those that refinanced or bought in 2021 at 3%, 5.625 is high. But we'll watch it. And if and when we ever get the opportunity, all of those people are going to get rolled down to a lower interest rate.
Good stuff.
Jeb, this is the last 5 days. I kind of like this look of just showing you guys. So we really have not gone anywhere. The red is what we want to see because it means yields on the 10-year going lower. But Wednesday, Thursday, basically treaded water a little bit better on Monday, gave it back yesterday, and a little bit worse still. We'll look at the bigger, broader chart, but basically a long way of saying rates have not moved since last week, regardless of what the headlines are saying. Yesterday, we got jolts. Jolts shows this continued trend, although we had a little bit of a tick up towards the end of last year. Still a clear downtrend in job openings, weaker in labor. We saw quit rates down back to pre-pandemic levels where people aren't quitting jobs and feeling like they can go somewhere else and get a better job. So inflation-wise, that's positive. But, most people would take a little bit of inflation if it meant them making 5, 6, 7% or more money every year. And it looks like we're just transitioning to a slower market that doesn't have that. Today, we got CPI. So we had that 0.4 figure from last year fall off, replaced by a 0.2. So what did we end up, Jeff? Is it 2.8 is where CPI
2.8 and 3.1, yeah.
2.8 and 3.1 on the core. Looks poised to move lower because we're probably going to be seeing similar figures. This is what the Fed Watch, their live nowcast on inflation predicts 0.01 and 0.26 for the next month. And you see that we've got a 0.3 falling off. So you're going to be significantly lower this time next month. So 2.46 is where they're projecting the year over year. So from 2.8 to 2.4 over the next month. That's a pretty big improvement. Core is not moving quite as much. In looking at this, what's moving it, Jeb? The shelter inflation is finally moderating. It is still elevated. Like we said, the Fed was behind the curve because they weren't accounting for the sharp uptick in shelter inflation that lagged on the way in as inflation was going up. And they're a little slow on the uptake now as it's coming down. This here, Jeb, the podcast episode we recorded today, as you said, we're talking about tariffs. What do tariffs mean going forward? So this is Goldman Sachs. They are showing here the gray bar was what they think would happen with no tariffs. So at that point, by June of 2025, they thought PCE would be at 2.5%, and by the end of the year, down to the Fed's target of 2%. The previous Goldman Sachs baseline was a little bit higher than that, to about 2.4 by the end of the year. I still think they're high on this. Most people are believing now that the tariffs, there's an inflationary component to it, but it's also a recessionary component, that it just takes so much growth out of the economy that there would be a bigger disinflationary impact over the long haul. So with that, it's interesting to see for inflation. So here's the bigger look at the chart. We are in the middle of that down channel. The two yellow lines kind of show us what the high and the low looks like of this Tuesday. Hey, we need some consolidation at this level, kind of build a new base before we can make a move lower. So we've got that. We were looking at 1, 2, 3, 4, about 10, 12 days here sideways in this range. At some point, if we get some good news and it gets towards the bottom of that range, you've got about 412. So this whole range from the yellow line at the top and the yellow line at the bottom is only about 0.25% in interest. So we're near the high of that. I expect we can make a move towards the low end. It's going to take some weakness to get below it. What does it mean in terms of interest rates? I was quoting this a little bit earlier. 6.82 is where Mortgage News Daily is today. We're locking people, well-qualified borrowers, 700 plus credit scores below that. FHA and VA 622, 624. We locked an FHA earlier this week at 6.125 with no lender costs, no underwriting, no admin, no points, no nothing. So with that, rates are good relative to where they were a month or two ago, hopefully beginning to move better in the right direction for us.
Yeah. And if you're, currently have a rate looking to refinance, jebsmith.net/rate watch will get you on the rate watch list. And then if you like to talk to Josh, go through the pre-approval process, get a second quote, whatever it is, there's a link scrolling the bottom there, jebsmith.net/start. That'll get you in touch with Mr. Lewis and the team, and are going to move along to the reason you guys are here. Do some questions.
Staring at our pretty faces?
Yeah,
it's not staring at our pretty faces. It's not
no, they don't want to see that. They don't want to see that. But here, we got a couple of people that let us know where they're watching from. So we got Dave in Oregon, Heather H in Inglewood. So Heather, if you're looking to buy in Inglewood, you need to call me. There's a grant program where you can get $50,000, Inglewood. That whole area, $50,000 free. Anyhow, if that is of interest, make sure you reach out because I can definitely get you connected on that one. And then I think that's the only people that let us know they're watching from, Josh. So we got Lakewood, Joe in Lakewood, and Salvador in Oxnard. All right. Brian says, just a thanks for doing these. Still enjoy watching them after Josh helped me in August. Maybe we'll get refi territory soon. So thanks for being here and continuing to support the show. It means the world.
Jeb,
Josh,
before you move on, a little reminder for that. I get a lot of people asking, well, hey, we closed our loan with you in October, November, December. Can I get on the rate watch? Everyone that we close your loan automatically goes to the rate watch list. So don't worry. We will reach out as soon as there's something that makes sense.
All right. Good stuff. ZL says, thanks. Keep up the great work. We must be doing great work because that's the second one, Josh.
I like it.
Question is there a way to estimate actual replacement costs? Wondering why a home worth $300,000 is being default quoted at $450 of dwelling coverage. So Josh, thoughts on that?
I don't know who is quoting at that. We don't see insurance companies over quoting. We actually end up having to get the replacement cost estimate because for the most part, your land, some parts of the country, the land doesn't have a lot of value, but especially Southern California, other parts of the country where the land is super valuable, my home would be $500,000 or $600,000 to replace, which tells you the dirt is worth close to $1 million. So we don't need to insure the dirt. It's not going anywhere. What we do is we need a couple things. We need either in your policy, the guaranteed replacement cost, which is the insurer saying, hey, don't worry about it. We're providing this much coverage and we're guaranteeing we will replace it in the event of a loss. Or we have to get their replacement cost estimate that says how they are arriving at the cost to replace the home. So again, it's not something I'm seeing over coverage being quoted.
All right. Cuckoo Can. Oh, Cuckoo Clan. Is this Ku Klux Klan? What we got going?
No, it's the Cuckoo Clan.
I can't read the third. Cuckoo Clan. Culkin. Anyhow, about to enter escrow with a new build using the in-house lending team. Got 1.75% credit towards closing and a 4.99% interest rate on an FHA loan. Does this sound like a good deal? It sounds like
this sounds like bragging, not a question.
Yes, it sounds like a fantastic deal. Run, don't walk there. Good stuff. SF Miners, where can I see how much I'd owe in property taxes in California? So, Orange County, for example, has the Orange County tax collector website. I'm assuming wherever you're located, there is a county website that you can go to. LA has one. Essentially every county, it's all public record. You can go in there, type in your APN number. If you don't know that, you should be able to type in your address and it should give you the information that you're looking for. So
here's kind of the quick or easy button. If you're looking at a property, go to Redfin. You can go to sales and tax history. It'll show you the taxes that the current owner is paying. So again, California here is unique in that we have Prop 13. So they could be at a very low rate and you're going to get assessed at a higher rate. So what you want to do is take the current taxes, divide it by the assessed value. That should give you a pretty good expectation of what the rate is. And then, hey, if I pay this much for it times that rate is going to tell you your annual property taxes. The only way this comes out, doesn't work out for you. I had a couple here recently that the owners were 80 years old. They paid $60,000. So they're assessed at like $78,000 and they're selling the house for $800,000. It's not going to give you an accurate number, but as long as the current assessed value is somewhere in the range of what the home is worth, it'll give you an accurate rate.
All right. Katie is asking if they get a credit for a temporary buy down this year, would they still be able to streamline FHA refi if the rates drop significantly in the next year? And the easy answer is yes. It's not regardless of whether it's FHA or any loan. You get a buy down, you get a seller credit, you do whatever. If there's an opportunity to refinance, you're good to go. There's nothing.
It's better than that, Jeb. Killian down in Texas. What part of Texas was he in? Closed his refi just first couple weeks of the year here, and he had done a buy down. So we did a streamline about 6 months ahead of it adjusting, and basically his payment didn't go down because it was we got him a permanent fixed rate at what the current rate was, but he had a balance left in his buy down account because that's essentially what happens is there's an account funded here that subsidizes your payment as if it were that lower interest rate for the 1 to 2 to 3 years that you have the buy down. So whatever is not used in that account gets applied towards your closing costs in the form of a reduction of your payoff. payoff. So if you owe $300,000 and there's $2,000 left in that account, your payoff demand is going to be for $298.
All right. Salvador says, what could be a reason a seller puts their house on the market and then removes it the next day? It can be a number of reasons. I was talking to Josh earlier today, had a friend post something on social media yesterday about two different clients. One was a seller, one was a buyer. And essentially the messages were very similar, two different people, but the messages were, hey, listen, the economy doesn't look good right now. And they were primarily basing it on kind of the wealth effect of the stock market, right? The market had dropped, precipitously over the last couple of days and just doesn't look good. People get scared, decide to do other things. So in the case of one of the sellers, they wanted to pull their house off the market. They just said, hey, I'm going to wait. The buyer basically said, hey, look, I was thinking about buying a second home. I'm no longer going to do that right now. I'm just going to wait and see what happens. The reason I say that is because sellers, are emotional. Selling a process is emotional, just like buying a house is emotional. And so little things can change. I mean, maybe they saw a house on the market that they liked and they were like, hey, if I can get that house, I'll put my house on the market. They put their house on the market. The other one went into contract and they go, well, screw that. I'm not going to do this if I can't find the right house. That could be a reason. They could have lost their job, right? I mean, and said, you know what, I'm not doing this until I find employment. I mean, there can be so many reasons. I wouldn't read into it. The best thing is have your agent call their agent and see if there's an opportunity there. Sometimes properties just go on hold. They don't actually go off the market. They go on hold. And it could be because they've already got an offer. It could be because they need to change something or do something. So just, try not to read between the lines and just actually find out the real reason.
The question, Jeb, reminds me of a quote from As Good as It Gets, but I'm not going to say it here because I don't want to get in trouble.
I don't know what the quote is.
I'll tell you off air, so I don't lose fans and friends and followers.
Cuckoo Clan again.
Bro, hold on. He gave you the pronunciation
Where is it?
You stop messing it up. Kukulkan. He's a Mesoamerican god. We have a Mesoamerican god that follows the show, Jeb.
Okay. I don't know how K-U-L, you get Cal out of that, but I'm going to go with it.
He says it is, so I'm going with it.
Sounds like a North Carolinian pronouncing it. We screw things up when we talk. Anyhow, the question, Josh, you threw me off, says, my agent said when going over the deal, the builder is only offering to pay half of our exclusive agreement compensation, and the other half would need to come out of pocket since it can't be baked in. And then you ask, is that how it works? In this case, it sounds like that. If you've agreed on compensation with your agent and the seller isn't willing to pay it, in theory, you're on the hook for that compensation. Now, here's the thing. Everything's negotiable. You've agreed to that. So by contract, if you're moving forward with that property, then you're going to have to come up with it. You don't have to buy that property. You could buy another property where the seller might be willing to pay it all, and it doesn't have to come out of your pocket. So that's a chance. The other thing is you can get a credit from the seller to use towards things you want to use towards. In the case of a builder, sometimes you might be buying down the rate. Other times you might be using that money towards compensation so that you're not paying that out of pocket. So there's a couple of ways to skin the cat, if you will. So just, talk to your agent and, hopefully they're able to break it down for you. So hopefully that's helpful. Jay Holiday is in Torrance, so thanks for watching. You're pretty local. So has been looking around Long Beach. What's your forecast in that area? Much the same. Long Beach typically has a lower price than, say, Orange County. So a lot of people in North Orange County get pushed out and end up in areas like Lakewood, end up in areas like Long Beach, because a little bit more affordable. That said, there's a grant program in that where a lot of properties qualify in there where you can get up to 50 grand for free if you qualify. So, if you're looking in that market, reach out. Happy to connect you and see if that's something can work for you. Because again, we just closed one in Compton and the buyer's got $50,000. So on a $680,000 purchase, mind you. So what's that? 7-8%?
It goes a long ways.
Goes a long way. Right. Mina says, can you state again where to sign up for a strike price for a refinance of my mortgage? Josh.
Here, let's
just put up that QR code again.
Yeah.
There you go.
That
you can scan the QR code.
Yep. That we have her covering the
There you
URL
go.
as well. Either one.
So it's jebsmith.net/rate watch, because you might be watching on your mobile. So jebsmith.net/rate watch will get you there. So hopefully that is helpful for you. Sean says, should I get my real estate license? Sure. It's one of those things. I mean, hell, everybody has one, I think. It's just a matter of whether or not you know how to use it and what you're going to do with it, right? People think, hey, I'm just going to get a license and I'm going to be able to buy and sell real estate and help other people. You have to be a member of the board. There's education that you have to do almost annually now with the board with regards to ethics, and then every 4 years you have to pay money for education and stuff. So it's not free just to get a license. So it's and it's not all it's made up to be. That's what
Jeb,
I'll say.
I don't want to hear your realtor sniveling over
Right.
a little tiny bit of continuing education when every December I've got 4 hours for damn near every state we have a license in.
That is yes, I'm not bickering about it. It's not hard to do, but it's also, people think real estate's just this easy job where, hey, I'm going to do it and everybody's going to, use me. I think my experience tells me it's a little bit more difficult than that. So just
and it depends on where you are. Like, yeah. What are your thoughts on this, Jeb? Like Southern California, like legitimately every third person has a license. So they, the people with a license, even if they sell one home a year, one every 5 years, they feel as though every friend, relative, coworker should use them, even though they're not active in doing the business. And in other parts of the country, that is far less common. So to me, the license is more valuable if you're in a part of the country where if you go to a cocktail party, there aren't 5 other realtors there.
Yeah, in Orange County, everybody would be a realtor there. Josh, you're I
ask my own questions every week.
Yes, property sold as is basically means don't bother in asking to fix anything. I would say, yes, that is what they are saying most of the time. But here's what I'll tell you. I would say more than 50% of the time, even when that's being said, sellers are willing to do things. And that's because once you're under contract, you have leverage. Now, if you're asking them to do something crazy, replace a roof or do something, they're probably going to tell you to pound sand. But if you're asking for little things or small credits, especially health and safety items to get things done, my experience tells me most of those people are going to work with you. Doesn't mean they will, but I wouldn't shy away from a property saying as is just because it says that. Because I tell you, we get them done all the time where we get repairs completed, credits given, where we started that conversation off like that. And oftentimes it's the listing agent making that comment and not the seller. Like the seller may have said, hey, I don't want to fix anything. Let's try to sell this like this. And then the agent just takes it and makes their own, remarks in there that say certain things when, in fact, when you present it to somebody, it's, if it's logical, if it's reasonable, people are willing to negotiate. So that's kind of where I'd leave it. How do you connect with Josh? That link scrolling the bottom of the screen there will get you in touch with Mr. Lewis, jebsmith.net/start. What was it again? Cow Clan. Cow.
He's not the clan.
Hold
Stop
on,
calling
dude.
him the clan.
Cow Con.
Yes. Yes.
Con. All right, I got it. Hold on. Hey, Meta, who is Kukalkan? It didn't. Maybe it's not connected because
does it think
my
does it think the camera is a microphone?
My phone's on do not disturb, so it's not connecting. We'll try it before the end of the show. Are title fees, Josh, or processing fees reduced for a refinance through the original lender?
If you go back through the original lender, what do we mean by the original lender? So a lot of people say this. I had a client tell me today, she goes, hey, we want to refinance, but we're just going to call the servicer. And I said, well, okay, well, we did 3 refis for you. They're all very difficult. We helped you get insurance put back in place when your insurer canceled you because your roof was collapsing. We helped you find a roofer. We'd love to be able to help you with that again. So there's always this thought that there's some sort of magic. The servicer who you make your payment to every month, they operate a large call center that does retention. They may reduce fees. They're going to send you mailers that tell you that they will reduce fees. The title is not generally a portion of that. But what I will say is on refis, the company that we use, the title insurance is so heavily discounted that it's in most parts of the country is really shocking how little it is. For our past clients, we always go through and make it as reasonable as possible, because we want you to be able to take advantage of any dip in interest rates. So repeat customers, we're always going to take care of. So just know there's a difference in going back to the loan officer that helped you when you purchased the loan and calling the people that you make your payment to every month. In general, I wouldn't advise calling the servicer and asking them what they can do. It's a recipe for a little pain and difficulty. Caesar, who we talked about, we closed the refi for about a month ago. He popped up on here. He had called his servicer and they quoted him 7.99 on a loan that we ended up closing at 7.99 with almost 2 points in cost. We ended up closing at 7.49 with 0 points. And they told him it would take 60 days. That's pretty common when you talk to these call centers.
All right. This is a good question here. And this is actually something I'm putting the stuff together to do a video. But Sir Williams says, I watch the market and check listings in my area, and my property, one of the property websites basically says I've gained $122,000 in equity since I purchased in September. Other listings sites say around 14K in equity. And then he goes on to ask, how accurate are these sites? Well, I'm about to take photos on a property that's coming on the market here in Huntington Beach, probably early next week. We got to get the photos and the video and stuff done. Once that's done, it'll be on the market. But I went to Zillow and I went to Redfin and I did a snapshot of what they thought the property was worth, just so I can use it later. But for example, Redfin has the property. Well, let's start. Redfin, has the property at 1.564 million. So 1.564. Zillow has the same property listed at 1.472. So what's that? $80,000 difference. Ready for that, Josh? I'm going to list it at $1,650,000. So about $200,000 higher than Zillow, about $100,000 higher than Redfin. And I think we're priced competitively. I wouldn't be surprised if we got more than one offer at that price. So just, you got to know your market, got to know your property. But here's the caveat. As soon as I list that property for that price, Zillow and Redfin will both change their prices to reflect my listing price. That's what's crazy. That's what most people don't understand. They're going to change their number just based off me doing nothing more than putting it on the market at that price. So
stupid stuff like that, Jeb. We've talked about it here on the show. That property that I bought in Orange in the middle of COVID, we paid $500,000 for it. It was way below market. The house had been utterly destroyed. So with appreciation, with us completely renovating the property, it still shows the value as like 875 when it is $1,050,000. But it gets something in its head from what was paid for a property. Someone buys from a family member, someone, any number of things, gets a distressed property like mine. That's just probably 5 different examples we could give you of these numbers getting out of whack, and they just don't seem to adjust when there's reason. And this is Southern California, where they're mainly tract homes. They have a lot of very similar comps. If you're in an area where you have unique properties, bigger parcels, it can be even less accurate.
Absolutely. So to go back to your question and actually answer the question you asked, how accurate are they? It depends. I would not rely on it as the gospel. I would use it. I tell everybody it's a tool in the toolbox, but do not talk to an agent and have them run the numbers for you and give you a better idea. But I would think, depending on your purchase price, gaining $114,000 or whatever the number was since September is a lot, especially in more or less a flattish market for the most part. 14,000 is probably more realistic, but even then it's hard to say for sure, right? If you bought a $5 million house, then maybe $100,000. But if it's, in the under $1 million, then that's, we're talking over 10%, which are big numbers. All right. Salvador is asking an additional question about putting extra money down. So is it fine to give a little extra money on my mortgage every month, basically paying the principal down, Josh? Or should I wait until refinancing to do it?
There's no reason to wait, because every month that you pay it down, that principal that you put there, you're not going to pay interest on. So at 5.7% interest, the $100 that you put in principal, $200 in principal, saves you $5.70 a year. So it's a huge amount. It's not. It's let me do the math, Jeff. 50 cents a month but you do that month after month after month, it does start adding up. So even the smallest amounts, if you feel good about adding that to your principal, the only thing I say is I don't want people to be aggressively prepaying their mortgage if they don't have a nice safety net, they don't have some reserves, they don't have some money in a 401k that they could rely on in an emergency, because the only downside to putting the money in that home is it's locked. You cannot get it without refinancing again. And the cash out refinance is more expensive than the rate and term refinance that got you to that 5.75 that you have right now. So I would pay it as you go, as long as you're comfortable and you have savings elsewhere.
All right. Koo has another question, Josh. That's what we've shortened it to. Says, in the quote the lender gave me, it says property taxes. A friend of mine mentioned a supplemental tax he got when they bought. Is this different from the taxes on my lender quote, Josh? How does that work?
Do you want me to explain the joys of California supplemental taxes? So
Sure.
this really is a California specific thing. If any of you are in any other states and you know the supplemental taxes, it is an issue with Prop 13. So for a homeowner in California, no matter how much your home goes up, your property taxes can only go up 2% a year. So what happens over time is that the assessed value that you're paying taxes on is much, much lower than the value of the home. So let's say someone bought 20 years ago for $300,000. It's gone up to $800,000. Their assessment might be $450,000. If you buy that house, your home in California does not get immediately reassessed. So for a period of time, 3, 6, 9, 12 months, you're paying taxes on that previous assessed value of $450,000, even though you just paid $800,000 for the house. So once they reassess you, cool, now they have the taxes in line, and your lender will use the correct taxes based off of the assessed value of what you're paying for the home. But there'll be a difference for that interim period when you were paying taxes at that lower rate and should have been paying them at the higher rate. That's what the supplemental bill is. They generally break it up into 2 installments. For the most part, if you're impounding your taxes and insurance and the lender didn't do something stupid like give you a big refund of the amount in your impound account, you can send them the bills and ask them to pay it. They may not understand this because most of the call centers that handle your impound account are in other parts of the country, and the new person that's been doing this for 6 weeks doesn't understand California. But if you get to a supervisor, explain to them, hey, I've been paying $800 a month into my impound account. You have been paying out $400 a month on the lower assessed value, and I need you to pay this supplemental. You can generally get them to do it. But Kukalkan, more importantly, if you use jebsmith.net/start, we can go through this in great detail and explain it to you for your exact situation.
There you go. Sa says, on that note, how do you negotiate a lot where the seller is asking double what the assessed value is in a brand new community development? So, if you're talking, assessed value based on what taxes the tax roll says it's worth, that's not a real value. That's just
Has
what
nothing to do with anything.
has nothing to do with what that is actually worth. So when a seller sells a lot and they have a price, how do you negotiate it? You have to come up with what you think it's worth based on other lots that have potentially sold that are similar location, all of those things. And assessments, from counties, from cities, very, very, absolutely nothing here in Orange County. Other parts of the country, maybe they hold a little bit more weight, but can't really tell you how to negotiate that because, it's not something that's, it's like any other negotiation, right? You got to, figure out why they think it's worth that. And you've got to come up to an agreement with why you think it's worth what you are. And then you guys got to meet somewhere in order to make that happen. So it's just a negotiation. So Maddie says, I've noticed Zestimates, she corrected and says, in California are often skewed by tax assessment, which can be quite low depending on when it was last sold, Prop 13 value. That should have no impact because you can see homes that were sold, 50 years ago for $50,000. And if you look up the Zestimate, they're much closer to today's value than they are what someone paid for them back then. So I would say that the Zestimate does not use the Prop 13 value. In most cases,
I don't even think the assessed value or the tax would be for California. Other parts of the country, maybe they do have it in their algorithm as a component, but in California, they can be so far out of whack. Jeb, I saw one the other day that I was trying to figure out how I just said, go to Redfin, look at the assessed value and the property tax. that was listed for $780,000 was assessed for $53,000. So those differences can be massive in assessed value and actual value in California.
All right, I want to answer this one because this is garbage.
Wild.
Jess says, I feel quite locked in with my lender. They basically wouldn't give us a pre-approval unless we formally said we'd work exclusively with them. So we didn't get to take a day to compare lenders. Normal? No, it's not normal. In fact, I would run. I would go to a different lender immediately, because anybody doing business like that, for one, unethical, two, can overcharge many, many things. There's so many things wrong with that statement that I wouldn't even give them an opportunity to come back from it.
Well, it's stupid because I can't hold you to that. If I said that to you, Jess, and you go, okay, cool, give me my pre-approval. I give you the pre-approval. You can go pound sand, buddy. I'm going to go find 15 different lenders I want to work with because you're being a turd. There's literally nothing binding. I cannot have you sign an agreement. So on the real estate side, you guys can have a buyer broker agreement that says, hey, for a period of time, for a number of properties in a specific price range in an area, that you agree to work exclusively with me. We don't have anything similar to that on the mortgage side. No one can require that of you. And the fact that they're asking it of you tells you everything that you need to know about their ability to compete for your business in the open market.
There you go. Leanna says, is it better to do a cash out refi or a fixed rate equity loan and keep the payments separate? Currently at a 5.99% VA loan, Josh, so 6% VA, and we'll do a VA cash out refi. So Josh, is it better to, what are your thoughts?
The easy button is use Jeb's referral link there, get connected. We can go through this in great detail. The short answer is at 5.99, that's about where VA rates are at right now. So when we look at a blended rate, if you borrow $50,000 at 7.5%, that blended rate is going to be higher than what your current loan is. So if you're worried about, hey, prepaying it over any period of time at 5.99, that current VA loan is probably new within the last 2 to 3 years. It's not a 2020 or 2021 loan. So you're only a couple years into it. We can do a custom term so that you're not giving up what you've already paid into it. The benefit of keeping them separate, there are some tax issues in terms of acquisition indebtedness and equity indebtedness. We could go through that with you and you can talk through it with your tax preparer. But for the most part, easy short answer is with the rates that you gave us there, I would do the cash out, but maybe you feel differently.
All right, good. Tim, what's our take on the Rocket Redfin combo? So basically, for those of you who don't know, Rocket Mortgage decided to purchase Redfin for $1.75 billion. Meanwhile, Redfin like 3 years ago was worth like $10 billion, by the way. So why? What's my thought? Nothing. I don't care. It means very little. What it means in the bigger picture, honestly, is more first-time home buyers are likely going to pay more than they probably should, because they're going to get caught up in this idea that, hey, I'm going to Redfin to search. They're automatically going to connect you to Rocket. It's going to be this one-stop shop, and it's all going to be great. And vice versa. People that go to Rocket are going to get connected to a Redfin agent, so on and so forth. It's the easy button, which basically means in layman terms that the experience, the expertise is missing from the entire equation, all the way around. That's the easy button, but that's my thought. Josh, anything you want to add to that?
I love Redfin, the tool, the experience, their setup. And I will say this, we have a lot of transactions every year where there's a Redfin listing agent or even a Redfin agent representing the buyer.
I have friends that do Redfin.
There are Russ, my old assistant, his sister is a bigwig here locally with Redfin. She's really good. So it's professional. They have a system. I will say the best Redfin agents are generally not as good as an independent agent. The average Redfin agent is much better than the average real estate agent. So
no, vice versa.
Take that for what it's worth.
The average real estate agent is better than the average. You think the average Redfin agent is better?
Redfin doesn't have shitheads working for them, and they're all over the street.
People go to Redfin because they can't generate their own business. So therefore, they rely on a company to feed them business.
What does generating business benefit a buyer? It doesn't. They don't care whether you can generate business or not.
No, they don't care if you can generate business.
Can you service my transaction?
But most of those people don't have experience. They don't have the expertise because most of them have been in the business for a shorter
You've been
period
away
of time.
from doing loans long enough that you don't know or remember how many bad realtors there are out there. I've never had a bad experience with a Redfin agent. I regularly have bad experiences with non-Redfin agents.
Well, there you go.
I'm not saying I've ever had a great experience with a Redfin agent either. And we regularly have great experiences with independent agents who have a super awesome system that they've put together. You're settling for average.
I would argue that and say, if you are buying a house, use somebody referred to you. Don't go to Redfin and use their agent. That's my recommendation. And maybe I'm biased because I'm not a Redfin agent. I could be one, but I choose not to be for so many reasons. So, to each his own. Talk to both and see what you like. If you want a little kickback of your commission and less of an experience, then that might be the right opportunity. And less negotiation and less everything. Sure.
Basically, the only thing you're getting is a safety net from having a terrible experience, because there's enough, it's enough of a system there that it's not going to be the awful experience you can have with some independent agents. But from that perspective, Rocket is one of my least favorite companies in the history of the world. They're built on a foundation of call centers, high pressure, not telling the truth, hiding facts, selling you on things. So I tend to look at this, and my feeling is that the Rocket culture will end up polluting whatever culture Redfin has, and you'll get the worst of both worlds.
Yeah, it's well, again, there's a reason that Redfin was for sale to begin with. It's always this easy business model that, hey, all these companies are going to change the industry. Open Door. I think I saw the other day, Open Door is worth like $1 now. It's all of these companies are going to upset the industry, that they're going to change everything. And over time, what happens is they don't have nearly the impact that people want them to have or thought they would have. And in the case of Redfin, I can't say that that's the case, but I can tell you it's dropped, 90% of its value from just a couple of years ago. And now it got picked up. So if they were, just killing it out there, the reality is they would be in a different position, and probably wouldn't be selling, and likely has to do with compensation, which there's a question regarding that here in just a minute.
Well, Jeb, analyst coverage of this merger or acquisition basically is focused on why Redfin is valuable. It's because of their SEO. It doesn't say the real estate experience.
It's a great website. It's easy to search. It's pretty. It looks a lot better than Zillow.
1,000 times better.
It's pretty, but that's where it kind of falls off. But anyhow, Bleed Green says 634 mid score. Went to my credit guy. Home takes 7 months to build. When should I lock in rates? 5 months? Question mark.
Show up here every week and just watch the beginning of the show and see what we talk. Like right now, I wouldn't be locking 5 months out. I'm pretty optimistic that rates are going to be lower, but that can change. It can change quickly. So again, the best bet is just show up here every week, and we'll cover the numbers.
Maybe not 5 months out. Should they lock in 5 months? Maybe 2 months before it's done, I think is the way I read that.
2 months out. Again, who knows? Are we still in a downtrend in 5 months? Then we wouldn't want to lock. If we're in 5 months, we're like, hey, rates are now 6%, and I'm worried they could pop back up to 6.5%. Maybe you lock it, but there's no way of knowing what's going to be happening 5 months from now. I would just keep my eyes on it and stay very focused from about 90 days out in terms of what's happening.
All right, Josh, we're at an hour right now, but let's knock through some questions here because there's some good ones that I think we can cover pretty quickly. There was one here, Josh, there was one that asked on compensation. I want to click on it.
I got it.
You got it? There we go.
Yep. It's Brett Landis. Since August and the change to where buyers have to pay their agent, have you been noticing sellers still paying for both agents?
Yes. I would say that the majority of the time sellers are still paying compensation. It's negotiated now more so than it was. Instead of say a certain percentage across the board, sellers are negotiating agents. And then, in some cases, buyers are picking up the difference. Sometimes agents are renegotiating with their buyers and just letting it go. So you're seeing everything, but I still, for the most part, things are still status quo for the most part. So
I've had a
hopefully that's helpful.
grand total of one transaction it was for a listener here to the show in the Phoenix market that his agreement was for 2.5 or 3%, and the seller was paying 1.5. So he paid 1.5 out of pocket. That's the only one I've seen where my buyer has paid their own agent.
I've had some where buyers have paid. A couple of them buyers have chosen to pay it out of pocket to make their offers more to stand out a little bit, and then others, it's been partial and a negotiation because the seller wasn't paying it. So a little bit of everything. Josh, why would a lender ask you to waive an appraisal?
I'm never going to ask you to waive an appraisal. And Jess, if you don't have a property under contract, no one could know whether you would get an appraisal waiver. So it's determined by the automated underwriting system. So once you have a property, we'll run it through. The offer that Jeb wrote today, it's a unique situation, or it's new situation, I should say. Fannie and Freddie just updated their algorithms where you can get a waiver with as little as 10% down. We got one for Caesar a couple of weeks ago on his new purchase, and we got one on that property because we had the property address. We run it through. They're putting 10% down. It gives us the waiver. If you get a waiver, I would never personally pay for an appraisal. Saves money, saves time. You and your agent are going to have seen properties and know whether you think the value is there. If you feel differently and you want an appraisal, go ahead. So I don't know why they would be talking about a waiver, asking you to take an appraisal waiver, but then also showing you on your closing costs that you're paying for an appraisal. If you accept the property inspection waiver or the automated collateral evaluation that Freddie Mac uses, you would not be charged.
There you go. I didn't mention this earlier, but Bleed Green gave a super chat for $5. Thank you for that. I completely blanked when I clicked on the question, didn't say thank you. So I appreciate that. We appreciate that, and appreciate you being here.
And come back and comment in a couple months and let us know how high you're able to get that credit score with my credit guy. I've had them take people in 90 to 120 days from
Did you make that referral?
I don't know. I don't remember the screen name, but we have had them take people from 570, 580 up to like 650, 660, 680 within 90 to 120 days.
All right. Can you refinance to interest-only mortgage for a house more than $1 million in Northern Virginia?
Absolutely. Realize that those are non-QM loans for the most part. They're going to have higher interest rates to start with, and often mitigates the benefit of that interest only. So if you're looking and saying, hey, Mortgage News Daily says jumbo rates are 6.95 today, you're not going to get 6.95 on an interest only. It's going to be higher, and that higher rate is going to offset the benefit of the interest only payment.
They came back and said you did make the referral, Josh. So good on you.
Excellent.
Yeah. Good.
We want to hear a strong report of how it works out for you.
Yeah, there you go. Shamir says, love the show. Question for you, Josh. How long do you have to own an investment property before a lender would accept it as income to qualify for a loan if the property is paid off?
I don't, maybe shoot me an email. You can just send one to info@theeducatedhomebuyer.com, and Jeb and I will both see that. I would have to look for certain, but there shouldn't be a limitation as long as you have the lease, and then they're going to want proof of receipt of rents and proof of the deposit. As long as we can show you're receiving it. If it hasn't hit the tax return, we're going to use 75% of the rents. So as long as it's an investment and we can show it and document it, you should be okay. Before I said that definitively, I would want to do a little bit of research though.
All right. Jess follows up, 720 credit score, a little bit more than 3% down, conventional loan, $380,000. Interest rate is 6.94%. Josh, are they being overcharged?
There's a million things that go into this. The clients that we locked last night, they just got their property under contract, 3% down, 800 credit score, 6.49, 0 points. The borrowers today, we're putting a bigger down payment and a 730 credit score. So 720, 730, anything from 720 to 739 is going to be in the same tier. They were about 6.875, 0 points. From everything you've told us about this lender, I'm going to go out on a limb and say you're being overcharged. If we saw the whole thing and we saw box A, I have a pretty solid idea of what it looks like.
There you go. So with that, guys, if you found any value in tonight's episode, do us a favor, hit the thumbs up. If you're not already subscribed, consider doing that. The Educated Homebuyer podcast is separate from my main channel, right? It's Josh and I taking a deep dive. Next week, we talk about lender credits. Comes out on Monday. You want to know how to get a free refinance? You want to know how to get a quote unquote free loan where you're not actually coming up with money out of your pocket? We address it on Monday's episode. So go over and check that out on the Educated Homebuyer podcast. This shows up every Friday. on that same platform, whether it's Spotify or Apple, wherever you listen to your audio. But if we can be of assistance, get in touch. If you need a realtor, you need a lender, jebsmith.net/start. You want to get on the rate watch, jebsmith.net/rate watch.
Jeb, let's just hit this on the way out. Midwest Workshop says Rocket quote. Rocket Mortgage quoted me a refinance at 7.5 on a $264,000 loan. They quoted a 20 at 599 with 11,000 in closing costs. Then your favorite one, Jeb, they'll let them do a free refinance in the next 18 months. They're going to overcharge the shit out of you, but magically, if you come back, they're going to do it for free. So I don't begrudge any of you. If you've seen the commercials and you think that the Rocket technology is great, call them, talk to them, but talk to someone else. So it sounds like you're somewhere in the Midwest. Use that Jeb's form there. I would love to give you a second quote. We have never lost a loan to Rocket, and we've taken hundreds. So from that standpoint, just again, if you feel like it's something you want to do, always check with Rocket. Get a quote from them. Compare with someone local. It's always going to be better.
All right, guys. Until next week, make sure you're buying right, borrowing smart, and building wealth. Hey, Meta, in the show. Adios.
Amigos.